The ratio of Bitcoin to gold will be displayed by me. Bitcoin is often referred to as digital gold by many. We would classify it as a risk-off asset, a place to keep money. Additionally, last year in March, when the regional bank index CRE was collapsing, Bitcoin surged 40. The regional bank index is behaving radically once again. Bitcoin is catching on again after a brief drop, and the introduction of 11 exchange-traded funds at ETFs, the concept that it's a journey towards excellence or security, is thus making a comeback in this context. A lot of people bought Bitcoin or the ETFs in anticipation of their release, which is why we think their price dropped once they were presented. On the news, there was some selling. People with this personality type tend to be very opportunistic traders. There are 19.5 million Bitcoin in circulation, and 15 million of those are in strong hands, as you may be aware from listening to In the Know. It has been over 155 days since they last transacted with their Bitcoin. Plus, as you can see from the graph, Bitcoin has been on the rise even when compared to gold. An alternative to Bitcoin has just emerged, and we expect that trend to persist in the future, especially because there is a less complicated and less troublesome alternative. In order to get Bitcoin, the chief executive officer of ARK Invest, Cathie Wood, is well known for her support of cryptocurrencies and Bitcoin in particular. She recently updated investors on her view that Bitcoin's market cap will surpass that of gold, reaching over $650,000 per coin. Cathie drew a comparison between Bitcoin and digital gold, highlighting the latter's stability and usefulness as a store of value in times of economic uncertainty. She made an analogy to the way gold acts when the economy is unstable, bringing attention to the fact that Bitcoin's price increased by 40 in March of last year in response to a regional financial crisis, which is consistent with what one would anticipate from a risk-off asset like gold. Cathie also detailed the long-term optimistic effect she expects freshly issued Bitcoin ETFs to have on the price of the cryptocurrency. Cathie gives some insightful predictions about the economy for 2024, so make sure you watch all the way to the conclusion of the video. Powerful headlines accompanied the story. The employment rate for non-farm payrolls stood at $353,000, which was almost twice the $185,000 forecast. Perhaps most importantly, if you put any stock in these figures, there was an increase of $117,000 from the previous month, bringing the total up to $333,000. It's just astounding. December and January are obviously fairly seasonal months, but when added together, they showed a $686 increase in employment, a thriving economy that is, or does it, well, domestic work. Corporations and businesses that are not involved in farming should conduct payroll surveys. Also, surveys of households often include more small businesses than large ones. In January, household employment fell by $31,000, not to mention a $683 drop in December. Thus, a total of $714,000 was lost over those 2 months. Which one is appropriate then? In all candor, this report is completely off the rails. I believe Hedgie referred to it as a ridiculous employment report, but they released it today anyhow. On top of that, they brought up the fact that full-time work has shown no improvement in the last year. Actually, it has dropped slightly. Employment in the part-time sector has increased by $870,000. Unless everyone is jumping on the bandwagon for the gig economy, this isn't a good indicator. The average hourly earnings were another contentious statistic that was released with this report. The gain was 0.6, therefore 5 per year. Its yearly rate of operation had been 0.3, or about 3.5. It is currently up 4.5 from the same time last year. It had been 4.1 higher year over year the previous month. Unless recent productivity data, which are very strong and would lead us to believe that many technological advances, particularly in AI, are beginning to influence the economy on an annual basis, the Federal Reserve will not be pleased. Productivity in non-farming sectors has rose 2.7. In other words, 4.5 minus 2.7 equals about 1.8. I'll have to do the maths. So, it's lower than the 2 targets set by the Fed. The report also included an intriguing number. The average work week fell 0.6, which could have been influenced by the weather. A severe downturn can only occur during severe weather or a recession. So, in this ongoing recession, we might see both of these things. For reasons other than the weather, I'm giving this one more attention than usual since it fell 0.3 in December. That makes it 2 months in a row. Additionally, the recently released real-world data is a major focus of ours. There are 12,000 layoffs at UPS. As you can see, announcements of layoffs are common. One reason these announcements have come to light is that many companies' revenue growth has turned negative. Actually, we're witnessing negative revenue growth, 3M minus 4.5 year over year, in what I would refer to as the traditional world, the old world, or the non-digital world. There goes the volume and price. Nominal gross domestic product is the same thing. Year over year, UPS saw a decline of 7.8%. A global impact is achieved by these businesses. Perhaps that is the current situation. The Chinese economy appears to be in free fall. Without a doubt, that is how its stock market appears. And the numbers don't add up. Maybe the Chinese debt load from 20 years of buy-the-dip real estate transactions became too much to bear. China has a lot of unfavorable statistics. And Europe is in recession according to some metrics. Therefore, it is possible that the global situation is making things worse for these multinationals. However, I do not believe that our world is completely cut off from the rest. Many questions remain unanswered, as anyone who has been following in the know for any length of time can attest. I have been predicting that it will be exceedingly perplexing. And that's only the beginning. Prior to introducing you or Brett, there is one last item on my mind. I overheard portfolio managers in the late 1970s, when I was a college student just starting out in the industry, lamenting the biggest professional error they had ever made. When the United States abandoned the gold exchange standard in the early 1970s, chaos ensued and prices began to spiral out of control. The oil embargo caused oil prices to quadruple. Nominal terms were used by the majority of economic indicators. Real from price and real from inflation were not separated. As a result, they failed to comprehend the market's decline despite profits that were skyrocketing. And they continued to purchase the dip. At the time, inflation was the sole factor driving up wages, so it was a huge error. Even if inflation were to reduce earnings, the market would not compensate for it. At that point, we began to differentiate between inflation and real growth. We may be on the other side of that issue, but we've been there since today. Real gross domestic product is now the standard by which most portfolio managers measure economic health. On top of that, they are aware that the market will not cover inflation, so it is just another metric. Okay, so far so good. But then you hit a walling negative revenue growth due to falling prices, companies losing pricing power, and weak unit volumes. This leads to negative money growth. Here we are, back in this inverted world. We attribute our current situation to the ongoing deflationary trend of disruptive innovation, which we believe will lead to widespread creative destruction. Two types of deflation exist: good deflation, which is linked to innovation, and bad deflation. As a result, we expect the price indicators, which include broad-based metrics like the CPI and the PI, to go into negative territory this year. Deflation has been mentioned as the greater danger for a while now. Inflation, falling prices, and weak underlying economic activity are all things that companies are just now beginning to report. Innovation solves problems, we say time and time again. Additionally, we believe that one of the most pressing issues that businesses will face in the coming years can be addressed through innovation. That, we believe, is deflation. Margin losses could be severe due to deflation. In this era of artificial intelligence, we believe that companies who actively embrace innovation will benefit.